Two tankers just cleared the Strait of Hormuz. For the first time since the conflict began on February 28th, commercial vessels are moving through the world's most critical oil choke point. The LNG tanker Mubaraz successfully exited the strait loaded with Qatari gas bound for China. The crude supertanker Idemitsu Maru, carrying 2 million barrels of Saudi crude bound for Japan, has begun exiting the waterway. Markets noticed. Headlines celebrated. Politicians pointed to de-escalation. But here at Signal Markets, we look at the data, not the headlines. And the data tells a much more complicated story. Before we go further, nothing in this video is financial advice. Signal Markets is an educational channel. We analyze publicly available data and research to help you understand how markets work. Always do your own research and speak to a qualified advisor before making any investment decisions. Let's start with what actually happened. Before the conflict began, an average of 129 vessels passed through the Strait of Hormuz every single day. That is according to the United Nations Trade and Development Agency. 129 vessels per day, every day, carrying 20% of the world's oil and 20% of its liquefied natural gas. Through the entire month of March 2026, just 154 vessels crossed the strait in total. That is 1 month's traffic compressed into what used to be a single day and a bit. Traffic through the Strait of Hormuz ran at approximately 5% of its pre-war average. Now, in late April, 2 tankers have cleared the strait. Even on the best recent days, vessel traffic has been as low as 3 ships per day, compared to 120 to 140 in normal conditions. That is still a 97 to 98% reduction in normal traffic. The honest question is this: does the passage of 2 symbolic tankers represent a genuine turning point, or is it a carefully managed signal designed to create the impression of de-escalation without the substance of it? The data suggests the latter. Here is the bigger strategic picture that explains what Iran is doing. The Wall Street Journal reported this week that Iran is now flooded with so much unsold oil that it is stashing it in derelict and abandoned storage tanks. Tehran cannot sell its oil because of the U.S. naval blockade of Iranian ports. It cannot export through the strait because of the dual blockade situation. And its own oil fields are still producing, meaning storage is filling up with oil that has nowhere to go. This creates a race to the bottom between 2 sides, both absorbing enormous economic pain. On Iran's side, oil revenue has collapsed. Storage is filling up. The economy is under severe strain. But the regime calculates that controlling the strait gives it maximum diplomatic leverage. The only card powerful enough to force the United States to the negotiating table. On the global consumer side, oil prices have surged to record levels. Physical crude oil prices hit nearly $150 per barrel in April, according to the International Energy Agency, far above futures market prices, creating what the IEA called an increasingly acute physical futures disconnect. Inflation is rising globally. Economic growth is slowing. The pressure on governments to find a resolution is intense. The 2 tankers clearing the strait are Iran's way of showing it can manage the situation, allowing just enough traffic to prevent total market panic while maintaining enough restriction to keep its leverage intact. This is not a reopening. This is a controlled valve. The International Energy Agency's April 2026 oil market report contains numbers that every investor needs to understand. Global oil supply plummeted by 10.1 million barrels per day in March. OPEC Plus production fell 9.4 million barrels per day, month on month. Global crude oil demand is now projected to decline by 80,000 barrels per day on average across 2026. A demand destruction signal that tells you the high prices are already slowing economic activity. The IEA's base case forecast assumes a resumption of regular deliveries from the Middle East by mid-year 2026. But the IEA explicitly acknowledges that this scenario could prove too optimistic. Their alternative scenario, where risks to energy production and trade remain high due to a prolonged conflict, is increasingly the one markets are pricing. And here is the number that should concern every investor the most. WTI crude rose 2.6% today to $109 per barrel. Brent closed above $118 yesterday, the highest since June 2022. Oil is not falling on the news of 2 tankers clearing the strait. It is rising. Markets are telling you something. They do not believe this is over. Here's the factor that makes a rapid resolution almost impossible, even if a political deal is reached tomorrow. Iran laid sea mines throughout the Strait of Hormuz when the conflict began. This is confirmed by U.S. military sources and widely reported. The problem, according to reports, Iran subsequently lost track of some of the mines it planted. The exact locations of all mines in the strait are not fully known, even to Iran. The United States has said it will take 6 months to clear the mines it believes have been laid, even after a ceasefire. 6 months of mine clearance operations in an active conflict zone with imperfect knowledge of where all the mines are. Trump has ordered mine sweepers to triple their clearance activity, but physics and maritime engineering don't respond to executive orders. Mine clearance is slow, methodical, and dangerous work. What this means practically, even if Iran and the United States reach a political agreement tomorrow, a ceasefire, a nuclear deal, a full diplomatic resolution, the Strait of Hormuz cannot fully reopen for commercial shipping until the mine clearance is substantially complete. War risk insurance will not be reinstated until shipping companies and their insurers are confident the waterway is safe. The insurance point is crucial. Major shipping companies, including Maersk, CMA CGM, and Hapag-Lloyd, suspended all transits at the start of the conflict. They will not return until war risk insurance is available at commercially viable rates. That insurance will not be available until the mines are cleared and the security situation is demonstrably stable, not just announced stable. This is why oilprice.com's analysis concluded with a stark warning. The Strait of Hormuz may reopen, but the system has already broken. Even after the Bab el-Mandab Strait was stabilized after the Houthi crisis, shipping traffic remained structurally depressed for years. The same trajectory is now playing out at Hormuz, but at far greater scale. So if a genuine reopening is months away at minimum, what does that mean for oil prices and the assets you hold? For oil prices, the base case remains elevated. Brent above $100 per barrel is likely for the duration of Q2 and potentially Q3 2026. The mine clearance timeline alone pushes full normalization into Q3 at the earliest. For energy equities, the prolonged disruption continues to benefit oil majors. ExxonMobil, Chevron, Shell, BP, and Total Energies are generating record cash flows. Energy sector ETFs remain the clearest beneficiary of this macro environment. For inflation, the longer oil stays above $100, the more persistent the inflation problem becomes. The Federal Reserve cannot cut rates in this environment. Central banks globally are paralyzed by a supply shock they cannot fix with monetary policy. This is the definition of stagflation, and it has months, not weeks, left to run. For gold, the safe haven bid remains fully intact. Geopolitical uncertainty, plus inflation, plus paralyzed central banks, is the perfect macro environment for gold. There is no scenario in this outlook where gold's fundamental case weakens significantly in the near term. For stocks broadly, continued headwinds. Energy costs are compressing margins across most sectors. Consumer spending is being squeezed by fuel and food prices. Earnings expectations are being revised down. For crypto, Bitcoin continues tracking equities closely. No safe haven function in this crisis. Watch the correlation with the S&P 500. If it breaks below 0.5, crypto may be finding its own footing. Above 0.6, it remains a risk asset subject to the same macro headwinds as stocks. The 2026 Hormuz crisis has permanently changed the global energy infrastructure calculus. Even after the strait reopens, the world has learned that 20% of its oil supply can be cut off by a single geopolitical event in a 33-kilometer waterway. That lesson will drive structural investment away from Hormuz dependency and toward alternative routes. Saudi Arabia's East-West pipeline to Yanbu on the Red Sea, the UAE's Abu Dhabi crude oil pipeline to Fujairah, Iraq's Kirkuk-Ceyhan pipeline to the Mediterranean. Investment to expand these alternatives will accelerate dramatically. This means long-term upward pressure on energy infrastructure investment, higher structural oil prices as risk premiums become permanent, and the energy transition, solar, wind, nuclear, battery storage, just got a massive additional tailwind. Clean energy is no longer just an environmental story. It is a national security story. 2 weeks of tanker data. That is the signal. If vessel traffic through the Strait of Hormuz recovers from 3 per day to 30 per day within 2 weeks, that is a genuine de-escalation signal and oil prices will fall. If vessel traffic stays below 10 per day despite diplomatic announcements, the crisis continues regardless of what politicians say, and oil stays elevated. Track it yourself at marinetraffic.com. The data is free, real-time, and tells you more than any press release or political statement. To summarize today's key signals, 2 tankers clearing the strait is symbolic, not structural. Traffic remains at 2 to 5% of pre-war normal. Iran is managing a controlled valve, maintaining leverage while preventing total market panic. Mine clearance alone takes 6 months minimum, making full reopening impossible even with a political deal tomorrow. Oil above $100 per barrel is the base case through Q2 and likely Q3 2026. Energy, equities, and gold remain the clearest beneficiaries. Stocks broadly, crypto, and bonds continue to face headwinds. The long-term signal, the Hormuz crisis, has permanently accelerated the energy transition investment thesis. Watch the tanker count at marinetraffic.com. 2 weeks of data will tell you more than 2 months of headlines. If this kind of analysis is useful to you, connecting geopolitical events to market signals and investment implications, subscribe to Signal Markets. New video every week. No noise, just the signal. Link to our recommended platform is in the description below. As always, do your own research, and nothing in this video is financial advice. This is Signal Markets. Find the signal, ignore the noise. See you next week.